The US Treasury just sold $69 billion of 2 year government bonds. Foreign demand is falling sharply, and the bond market is screaming yet another warning to the Fed. So here we had a $69 billion 2 year auction today that just wrapped up. Again, if you're not familiar with how a bond auction works, it's in the style of a Dutch auction, which is you have a starting price, in this case, $100, and you go down in price until all of your supply that you're trying to sell, in this case, 100 units, you go down in price until all 100 units are accounted for. There is a bid for every single unit you're trying to sell. If you have to go down in price, that is called a tail. Because again, you're being forced to sell your item at a discount to what the price was when the auction started. However, in the exact opposite of that, if there's very, very strong demand, you actually will have bids above the starting price. That is referred to. It's the same concept. The difference between the two prices, it's the same concept. It's just called a stop through. And again, that indicates generally strong demand. Now, the other metric to familiarize yourself with is bid to cover. This is very simple. This is just the total number of bids divided by the total amount of supply. In this case, we have 350 bids, and they're only trying to sell 100 units. So the bid to cover is 3.5. Very, very strong demand. You get a higher bid to cover. Weak demand, you get a very low bid to cover. Anything below 1.0, the Treasury auction would be a failed auction. That is what that term means when people talk about it. Here we can see the bid to cover was 2.51. We sold $69 billion of 2 year notes in a single auction. And here we can see the composition. Now, it did stop through ever so slightly, only a tenth of 1 basis point. Basis point is 100th of a percent. So basically a rounding error here on the stop through, but it did stop through nonetheless. And we got a bid to cover of 2.51. The interesting story is not necessarily the tail or the stop through, although if we look at that, this chart is provided by Zero Hedge. We can see that going back really to for the past year or so, the short end of the yield curve, like the 2 year Treasury, has had relatively healthy demand. Yeah, there will be a month here or there where you get a significant tail, but generally speaking, we can see, especially over the past 5 or 6, 7 auctions, we can see that it has stopped through, again, indicating generally strong demand. Here's where it's really interesting. So if you look at the composition of who exactly is bidding for these 2 year notes, we see indirect, that is in green. What indirect represents is foreign demand. Primary dealers, that's in red. You don't want to see a large share of primary dealer takedown. Primary dealers are basically the buyer of last resort. They are the buyer where everyone else has stepped away. They have a special agreement with the government, with the Treasury, where they are basically expected to come in and buy every bond that no one else wants. So you don't generally want to see primary dealers taking down too much of the supply. And then, of course, direct bidders, as we see in blue, those are firms that are bidding directly for their own firm, like a hedge fund or a family office that is bidding directly for their own portfolio. And what we can see is if we go back to January, February of this year, that was pretty large indirect demand. That was pretty large foreign demand during that period of time. However, over the past 9 or so months, we can see that that record amount of foreign demand has been waning. Now, the level that we're at today is roughly equivalent to levels that we saw in 2020, 2021, 2022. So it's not necessarily that foreign demand is cratering to a worrisome level, but it is decreasing pretty significantly from where it was at the start of the year. Hopefully that distinction makes sense. Now, the other warning sign that the bond market is sending, we, of course, got an interest rate cut back here on Wednesday, September 17th. And look at what rates have done. So here in purple is the 30-year. In blue is the 10-year, green is the 5-year, red is the 2 year. We can see the interest rates basically from the 2 year out in duration. So from the 2 year all the way out to the 30-year, interest rates have basically only moved higher. This is exactly what we saw during the first central bank rate cuts that we saw at the September, October of last year. When the Fed was cutting interest rates, we saw the exact opposite thing happen, which is interest rates moved higher. This is generally not what you see in an interest rate cutting cycle. Here's one, for example, in 2020. We can see that the Fed was cutting interest rates, and interest rates, generally speaking, over that period of time fell. The short term rates, like the 1 year, for example, in orange, or the 3 month in yellow, those fell the most sharply at the fastest pace. But all interest rates were falling. And if we go back to 2008 as well, during the GFC, the central bank was cutting interest rates, and we saw exactly the same thing, which is as the Fed was cutting the overnight rate, which is what we see in white here, that is the federal funds rate. As the Fed was cutting, we see interest rates falling, even at the long end of the yield curve. In purple, we can see the 30-year went from about 5.2 down to, at its low, about 2.6. This is generally what you see. During a period of economic weakness, the Fed will cut interest rates. Well, cutting interest rates is by definition stimulatory because you are lowering the cost of capital. So, if you have an already, say, 3% inflation like we see today, and you start cutting interest rates, well, that's going to spur even more inflation. And of course, what are long end rates going to do? Remember, if you're buying a 30-year treasury, you need to make sure that the interest rate that you're locking in today, right now it's 4.71%. You need to make sure that that 4.71% will be higher than whatever inflation is going to be over the next 30 years. However, if you see the central bank cutting interest rates when inflation is at 3%, whether you use CPI, core CPI, PCE, core PCE, inflation is at 3%. Their target is 2%. The Fed's target is 2%. If you see them cutting and inflation's at 3% and equities are at all-time highs, the stock market's ripping higher, you have gold ripping higher, home prices ripping higher at all-time highs, and the Fed is cutting interest rates, well, you're going to see exactly what we saw during September, October, November of last year, which is interest rates, 30-year, 10-year, 5-year, they all went higher. And this is again because the bond market is saying, look, Fed, you're making a mistake. You're cutting when you shouldn't be. Your monetary policy is too loose. It is too easy. You, if anything, should be holding interest rates, maybe even hiking, arguably with 3% inflation. And so the bond market is selling off because remember the yield is inverse to the value of the bond. So here we can see that the 30-year is down significantly from September when the Fed started to cut interest rates. Again, this is the exact opposite of what you normally see. And I think the reason is because they're cutting interest rates for a totally brand new reason that we have never really seen, at least in our lifetime. They're cutting interest rates because interest expense for the government is way too high. They're not cutting interest rates because unemployment is 15%. They're not cutting interest rates because GDP is contracting and printing negative prints. No, if anything, GDP is running pretty well, 3.3% for quarter three right now. So they're not cutting due to this cataclysmic recession with really, really high unemployment. They're cutting because of fiscal dominance. They're cutting because the federal government cannot afford the interest expense on the debt. And of course, they can do this. There's nothing to prevent them from doing this. However, you're going to get higher interest rates, especially at the long end of the yield curve, like we are seeing, by the way, not just with the rate cuts of last year, but if we zoom in to the since the rate cut last Wednesday, we can see the 30-year yield is higher, the 10-year yield is higher, the 5-year yield is higher, and even the 2-year yield is higher. So again, this is generally what you would see if the bond market is kind of revolting and telling the Fed, hey, look, you're cutting when you shouldn't be. Inflation is at 3%. Unemployment's at basically very close to record lows. The economy's fine. Equities are at all-time highs. Home prices are at all-time highs. And by the way, the message that gold is sending, gold was up yet another 0.5% today. This is yet another warning sign for the Fed. They keep cutting interest rates and gold just screams higher. Well, again, one way to think about this here, we're looking at gold denominated in dollars. Well, of course, if you think of it like a foreign exchange cross, if you look at the dollar denominated in gold, it is a much, much more concerning picture. The dollar, the amount of gold that each dollar will buy you is plummeting. The purchasing power of the dollar, at least in gold terms, is plummeting. So when you see that skyrocketing gold price, in the face of Fed rate cuts. Again, this is sending a very similar signal to what the yields are doing at the long end of the yield curve. But again, it's not even just the long end. Even the 2 year yield is up since the Fed cut rates. Really, the only thing that is down is, say, the very, very short end of the yield curve, like the 3 month, the 6 month, and the 1 year. Those are the only interest rates that have actually declined, despite the fact that we just got another 25 basis point rate cut. Well, again, the bond market is signaling to the Fed, you are cutting too much. You are cutting more than you should. Now, it's only been 3, 4 trading days, so it's a bit too early to draw a conclusive signal from these higher interest rates. But if this trend continues, this is something to keep an eye on over the next week or two. If this holds for another week or week and a half or 2 weeks, if we end up having higher interest rates a week from now than when the Fed cut, I think it's pretty safe to say that the bond market is sending the same exact signal that it was sending back during late last year when the Fed was cutting interest rates, which is you are cutting for the wrong reason. You are not cutting because the economy is so weak that it needs the cuts. You are cutting because the interest expense, currently 23% of tax revenue, currently $1.2 trillion a year, growing at an 11% year over year rate of change. That interest expense is blowing out your deficit, and you are forced to cut interest rates so that your government can afford its interest. We're going to demand higher interest rates. We're also going to sell government bonds and buy gold, because gold, you don't have to worry about a central bank making dumb decisions. So anyways, hopefully that was helpful. $69 billion in a single auction. Certainly the auction sizes are getting quite large, but it was a strong auction. So, the short end of the yield curve continues to see relatively robust demand. Again, the foreign demand is falling off from the record highs that it was at. But again, it's roughly in line with what we saw in, say, 22, 23, 24. So anyways, hopefully that was helpful, and I'll catch you in the next one.